Hello friends, my name is Harshit and welcome to my YouTube channel. So today I have brought for you the complete course on mutual funds for free. In the market, this course is sold for thousands of rupees. But after watching this course, you will not need to take anyone's paid course. So I have created this course chapter by chapter and have put the chapters on the timeline. So whichever chapter you want to view first, you can go to the timeline and watch it. So let's get started with the video without wasting any time. Hello friends, welcome to chapter 1 Introduction to Mutual Funds. So in the first lesson of chapter 1, we are going to discuss what is a mutual fund. So a mutual fund is a pool of money which is managed by a professional fund manager. A mutual fund collects and pools money from a large number of investors and invests the same in instruments like equities, bonds, government securities, and money market instruments. So, equities, as you all know, refers to stocks or shares, and other instruments which are listed like bonds, government securities, and money market instruments. These are all debt instruments. Now, coming to the third point, the money collected in the mutual fund scheme is invested by professional fund managers in stocks and bonds in line with the scheme's investment objective. So, if the scheme's investment objective is high growth, aggressive growth, then it will invest in stocks. But if the scheme's investment objective is capital preservation and moderate growth, then it is going to invest in debt and bonds. Now, coming to the fourth point, the profits generated from this collective investment scheme are distributed proportionately amongst the investors after deducting applicable expenses and levies. So, what are these expenses and levies? For running an asset management company, there are a number of costs involved which a company charges its investors in the form of an expense ratio. So, once these expenses are deducted from the profits, the profits are then distributed proportionately amongst the investors. Finally, coming to the last point, the fees and expenses charged by the mutual funds to manage a scheme are regulated and are subject to the limits specified by SEBI. SEBI stands for Security and Exchange Board of India, which is the stock market regulator. So, the expense ratios or the fees charged by the mutual funds, this is regulated by SEBI, and the asset management companies, they cannot charge beyond a certain limit, which is specified from time to time by the SEBI. In lesson 2, we are going to discuss why mutual funds are one of the best investment options. So, the first reason is professional management. So, mutual funds are managed by full time professional money managers who have years of experience in managing people's money. Second point is affordability and convenience. So you can invest in mutual funds in very small amounts, and this amount can be as small as rupees 100 in case of certain mutual funds. Now, usually there is a different amount for SIP and lump sum investments. For SIP, usually the amount is lower, and for lump sums, the amount is usually a little higher. Third point is risk diversification. So, investing in mutual funds helps you diversify your investments across asset categories such as equity, gold, and debt, which helps in spreading the risk. Now, usually, when I say that by investing in mutual funds, you invest in certain asset categories like equity, debt, and gold, this is true in case of hybrid funds. So, hybrid funds are essentially a type of mutual fund where your investment is divided into multiple categories like equity, debt, and gold. There are also certain mutual funds like equity mutual funds which invest 100% of their allocation is there in equity. There are also debt funds where 100% of the allocation is in debt. But if you want to diversify the risk, then it is better to invest in hybrid funds where a certain percentage of investment is in equity, a certain percentage is in gold, and a certain percentage is in debt. Then coming to the fourth point, mutual funds usually have a low cost. This is because there is economies of scale. Thousands of crores of investments are there in the mutual fund schemes, and hence the expense ratios are usually low in case of mutual funds. Then talking about next point, it is liquidity. So most mutual funds, they allow you to withdraw your investment anytime you want. Although some mutual funds may charge you a certain exit load, that is a small fee for exiting your mutual fund investment, and this is usually done when you exit your investments before 1 year. If you exit your investments before 1 year, you will have to pay a certain exit load in case of certain mutual fund schemes. If I talk about ELSS mutual funds, then these are tax saver mutual funds. ELSS stands for equity linked savings schemes. So these mutual funds, they have a lock-in period of 3 years, which means that you cannot withdraw your investments before 3 years. Next, coming to the next point, that mutual funds are well regulated. So mutual funds are regulated by SEBI, which is Securities and Exchange Board of India. So they have to follow the asset management companies which run these mutual funds. They have to follow the guidelines of the SEBI. So hence your mutual funds are well regulated. So coming to the last point, which is tax benefits. So if you invest in ELSS funds, that is tax saver funds, and if you invest up to an amount of rupees 1,50,000 in a financial year, you qualify for tax benefits under Section 80C of the Income Tax Act. So investing in ELSS funds is a really good way to lessen your tax. In this lesson, we are going to talk about the key mutual fund terminologies. So, coming to the first term, which is NAV or net asset value. So, the net asset value, it defines the price of a mutual fund unit. So, just like in the case of stocks, we have a stock price. In the case of mutual funds, we have an NAV or net asset value. Next, coming to the second point or the second term, which is AMC or asset management company. So, an asset management company is an institution that manages the funds of the investors. So, in India, we have tens of asset management companies, and some examples are SBI mutual funds and HDFC asset management company. Then all the major banks, they have their own AMCs. For example, we have AMCs from Kotak, we have from Axis, and so on. Next, coming on to the third point, which is SIP or systematic investment plan. So, SIP means that an investor invests a certain small amount of money at periodic intervals, and the periodic interval can be weekly, it can be monthly, or it can be quarterly. So, the opposite of SIP is lump sum. In lump sum investment, an investor usually invests a big chunk of money in one go. Coming on to our next term, which is AUM or asset under management. So, asset under management, it indicates the size of the assets which are controlled by the AMC, and it shows the performance and the credibility of the asset management company. Now, let us understand this with the help of an example. For example, there are two mutual fund schemes. In one scheme, the AUM or the asset under management is 10 crore, whereas in the other scheme, the asset under management is 1000 crore. So it clearly shows that the trust of the investors and the credibility of the mutual fund scheme is better in the second case, where the AUM is 1000 crore. Coming to the next term, which is exit load. So, exit load, it denotes the fees that the investors have to pay when they exit a mutual fund investment. So, the exit load varies from mutual fund scheme to mutual fund scheme, and a lot of mutual fund schemes, they do not have exit loads. So, the investor can withdraw their money whenever they want and they won't be penalized for it. Coming to our last term, which is expense ratio percentage. So this measures how much an investor will pay over the course of a year to invest in a mutual fund. For example, if you invest 100 rupees in a mutual fund and the expense ratio is 2%, then it means that you will pay 2 rupees over the course of the year to the AMC for managing your investments. Hello, friends. So, in chapter 2, we are going to understand the different types of mutual funds. So, in lesson 1 of chapter 2, we will talk about equity mutual funds and its different subcategories. So, equity mutual funds, they invest in the shares or stocks of different companies. Now, let us talk about the important features of equity funds. First is returns. So, equity funds are among the most high return funds, and you can easily expect 10% plus returns in the long term. When I say long term, I mean a time period of 5 plus years. The second important feature is the tax benefits. So, in equity mutual funds, there is a subcategory called ELSS tax saver funds where you can gain tax benefit if you invest in this category of mutual fund. The third important feature is risk. So, because equity mutual funds they have exposure in equities, so the risk is high in this particular category and it is also subject to a lot of market fluctuations. Fourth important feature is expense ratio. Now, since the equity mutual funds have to be constantly managed by fund managers, so usually the expense ratio is on the higher side as compared to debt funds. Talking about the last feature, that is investment tenure. So equity mutual funds they are usually suitable for long term investors who have a time horizon of greater than 5 years. Now we move on to the next slide and talk about the different categories of equity mutual funds. So, equity mutual funds they can be categorized based on the following parameters. The first one is investment strategy, the second one is market capitalization, the third one is tax savings, and the fourth one is investment style. So, let us now discuss the categorization based on investment strategy. So, the first classification based on investment strategy is thematic or sectoral funds. So, as it is clear from the name, these mutual fund schemes they invest in an emerging market theme or an international stock theme. Also, some of these funds they might invest in a particular sector of the market. For example, banking and financial services, pharmaceuticals, IT, etc. Now, because these funds they are investing in a specific sector or a specific theme, the risk is a lot higher. The second category based on investment strategy is the focused equity fund. So the focused equity fund they can invest in a maximum of 30 stocks. Also, they can invest in any segment of the market such as large cap, mid cap and small cap. Also, focused equity fund, they have a high return potential but also come with a high risk. Finally, the last classification based on investment strategy is the contra equity fund. These follow a contrarian strategy of investing. So the fund managers of contra equity fund they analyze the market to find underperforming stocks and then they buy these stocks at low prices under the assumption that these stocks are going to recover in the long term and they are going to give very good returns. Now we come on to the second classification or categorization, which is based on the market capitalization. So, based on market capitalization, we can classify the funds into large cap funds, mid cap funds, small cap funds, multi cap funds, and large and mid cap funds. So, let us now see each of these type of funds. So, in large cap funds, the fund manager has to invest minimum 80% of their AUM in large cap companies. So, what is AUM? AUM is the asset under management. And what are large cap companies? So, the top 100 companies basis the market capitalization are called the large cap companies. Now the second type is the mid cap funds. So mid cap funds, they have to invest around 65% of their asset under management in the stocks of mid cap companies. What are mid cap companies? Companies which are ranked 101 to 250 basis the market capitalization. So these are mid cap companies. Next, moving on to small cap funds. So they have to invest around 65% of their asset under management in the stocks of small cap companies. What are small cap companies? Those companies which are ranked 251st and below according to the market capitalization. Moving on to the next category, which is multi cap funds. So multi cap funds, they have to invest around 65% of their asset under management in large cap, mid cap, and small cap companies in different proportions. And finally, coming to the last category, which is large and mid cap funds. So these funds, they have to invest around 35% of their asset under management in large cap and 35% in mid cap companies. Now we will talk about the categorization based on tax savings. So the first one is ELSS, tax saver mutual funds. ELSS stands for equity linked saving schemes. So these funds, they offer tax benefits of up to rupees 1.5 lakh under section 80C of the income tax. Now, these tax benefits are only applicable if you have selected the old tax slab. If you have selected the new tax slab, then you will not get these benefits. So, the ELSS mutual funds, they invest a minimum of 80% of their asset under management in equity and equity related instruments. Also, ELSS mutual funds, they have a lock in period of 3 years. Next, we talk about non-tax saving equity funds. So other than ELSS, all the other equity funds, they are non-tax saving schemes because the returns of these schemes are subject to capital gains tax. Finally, we talk about the categorization based on the investment style. First is active funds. So, active funds, as it is clear from the name, these funds are actively managed by the mutual fund managers who select the stocks they want to invest in. Usually, the active funds, they have a high expense ratio. It ranges between 0.08% to 2.25%, depending on whether it is a equity fund or a debt fund. Equity funds usually have much higher expense ratios as compared to debt funds. Second category based on investment style is the passive funds. So passive funds, they usually track a market index which determines the stock that the mutual fund scheme will invest in. In passive funds, the mutual fund managers, they have no active role in the selection of stocks. They just track the index and invest accordingly. And passive funds have a much lower expense ratio as compared to active funds. And here in this case, the expense ratio is usually lesser than 0.5%. In lesson 2, we are going to talk about debt mutual funds and its different subcategories. So, debt mutual funds are funds that invest in securities that generate fixed income. And what are these securities? These are securities like treasury bills, corporate bonds, commercial papers, government securities, and many other money market instruments. So the returns in these securities are usually not affected by fluctuations in the market, and hence these securities are considered to be low risk investment options. Debt investments, as you must already be knowing, they offer lower returns as compared to equity investments over a longer period of time. And hence, these debt funds, they are preferred by investors who have a lower risk tolerance. Debt funds, they usually diversify across various securities of varying tenures to ensure stable returns. Also, you can expect returns in the range of 6 to 8% while investing in debt mutual funds. Now, talking about the categorization of debt mutual funds. So, let us now look at the various subcategories. These are overnight funds, liquid funds, money market funds, short duration funds, corporate bond funds, credit risk funds, dynamic bond funds, gilt funds, and long duration income funds. So the first subcategory is overnight funds. So as it is clear from the name, these type of debt mutual funds, they invest in fixed income securities that have a maturity of 1 day, and these instruments have no interest rate risk because of the short duration. Also, these instruments, they are backed by collateral which are consisting of the government securities, and hence these funds do not have any credit risk also. So this category of funds, that is the overnight funds, they are considered to be the safest category of debt funds, but their interest rate returns, that is the yield, is also usually the lowest. And overnight funds are suitable for parking your funds for a few days. Now we come on to the next category, which is liquid funds. So liquid funds, they invest in debt and money market instruments like commercial papers, certificate of deposits, treasury bills, etc., with a maturity of up to 91 days. Liquid funds, they have a very low interest rate risk because of the very short maturities of the instruments that they invest in. Also, liquid funds, they have a certain exposure to credit risk, and this risk depends on the credit quality of the instruments that they invest in. The high credit quality liquid funds, they have a very low risk, and they also offer higher returns, that is higher interest rates as compared to the savings bank accounts. Also, liquid funds, they charge exit load if you withdraw your money within 7 days of investment. So concluding, we can say that liquid funds, they are suitable for parking your money or your funds for a few weeks or months. Now we come on to the next subcategory of debt funds, that is money market funds. So money market funds, they invest in money market instruments like commercial papers, certificates of deposits, treasury bills, etc., that have maturity of less than 1 year. These funds have a moderately low price sensitivity to interest rate changes. Also, these funds, they are subject to credit risk, and the credit risk depends on the credit quality of the instrument that the fund invests in. Investors who have a moderately low risk appetite should consider investing in the money market debt funds. These funds, they are suitable for investors with a 1 to 2 year of investment tenure. And in case an investor is not sure about the investment tenure, then, in my opinion, it is best to invest in liquid funds or overnight funds. Now we come on to the next category of debt mutual fund, that is short duration funds. So, short duration funds, they invest in debt and money market instruments where the Macaulay duration of the portfolio is between 1 to 3 years. So, Macaulay duration is the weighted average of the time to receive the cash flows from a bond. And because of the relatively short duration profiles, the short duration funds, they have a medium interest rate risk. Also, short duration funds, they can have some sort of a exposure to credit risk depending on the credit quality of the instruments they invest in. So if they invest in high credit quality instruments, then the credit risk will be low. So short duration funds are suitable for investors who have a 2 to 3 year investment tenure. Also, investors who are investing for 3 plus years, they can get benefits of long term capital gains tax. Now we move on to the next category of debt fund, which is corporate bond funds. So corporate bond funds, they must invest 80% of their total assets in the highest rated instruments such as corporate bonds, commercial papers, and certificates of deposit. So this is as per the SEBI mandate that they have to invest at least 80% in the highest rated instruments. So now, what are the highest ratings? So the highest ratings, these are given by the credit rating agencies like CRISIL and ICRA. So for corporate bonds, the highest rating is AAA, and for short-term instruments like commercial papers and certificates of deposits, the highest rating is A1. So now, even though AAA and A1, this denotes the highest credit rating and the highest degree of safety, but these ratings can change over time depending on how the financial performance of the issuer has been. So investors should continuously monitor the credit quality of the funds on a regular basis. Next, coming on to the next category of debt funds, that are credit risk funds. So credit risk funds, they should invest at least 65% of their total assets in instruments which are rated below the highest rating. Hence, they should invest in double A or lower corporate bonds and A2 or lower short-term instruments. So the lower rated papers or the lower rated corporate bonds, they give higher interest rates, they give higher yields, but they also have higher credit risk. So the investors, before investing in credit risk funds, they should understand the risk associated with these funds. Now we come on to the next category, which is dynamic bond funds. So dynamic bond funds, they offer the flexibility to invest across durations depending on the interest rate outlook. So investors who want to invest for 3 years or more, they should consider investing in these funds. Also, by investing for 3 years or more, they can get long term capital gains tax benefits. Here, a suggestion from my side is to use SIP to reduce the volatility, which will also improve the returns of this fund over a long tenure. We now move on to the next category of debt funds, which are gilt funds. So, gilt funds, they invest at least 80% of their asset under management in government securities. Now, since they are investing in government securities, these funds are very safe and they have a very low credit risk. But a major drawback of this fund is that they have a high sensitivity to the interest rate changes. So they can give higher returns when the interest rates are falling, but if the interest rates rise, then they can be quite volatile. So investors who have a high appetite for volatility and at least a 3-year investment tenure, they can consider investing in the gilt funds. Now we move on to the next category of debt funds, which are long duration income funds. So long duration income funds, they invest in debt and money market instruments, and the Macaulay duration of the fund portfolio is greater than 7 years. Now long duration income funds, because they are investing in long term securities, they are highly sensitive to the interest rate changes. But these funds have a low credit risk because they are investing primarily in government securities. Now, because these funds have high interest rate risk, investors who have like a moderate risk appetite and those who want to invest for at least 3 years, only those investors should consider investing in long duration income funds. In lesson 3, we are going to talk about hybrid mutual funds and its different subcategories. So, a hybrid mutual fund is a combination of equity and debt financial instruments. Hybrid mutual funds, they aim to strike a balance between growth and income by investing in both equity and debt instruments. And the aim here is to diversify the portfolio. Hybrid mutual funds, they are suitable for all categories of investors, conservative, moderate, and aggressive, because there are hybrid funds for all these categories of investors. Now, the first time investors who are investing in the stock market for the first time, they can also opt for hybrid funds because there are varying level of risk, asset allocation, diversification, and capital appreciation in hybrid funds. According to SEBI, which is Securities and Exchange Board of India, there are 7 different subcategories of hybrid mutual funds. So let us now discuss each category one by one. So the first subcategory of hybrid fund is conservative hybrid fund. As it is clear from the name, this category is suitable for conservative investors because here only 10 to 25% of the investment is in equity, that is in the stocks, and the remaining 75 to 90% investment is in debt instruments which are considered to be much safer than equity. So the debt asset class here includes the fixed income generating securities such as the treasury bills, corporate bonds, commercial papers, and certificates of deposits. Moving on to the next category of hybrid fund, we have balanced hybrid fund. So the balanced hybrid fund scheme, it invests a minimum of 40% and maximum of 60% in both the equity and debt classes. So you can consider it to be a 50-50 investment in equity and debt. So investors who are looking for a long-term capital generation, they can opt for balanced hybrid fund. So here the debt instruments, they will help you to offset the risk which are posed by the equity asset class. Moving on to the third category, we have aggressive hybrid fund. So in this scheme, the investors, they can invest minimum of 65% and a maximum of 80% in equity asset class, that is in shares and stocks. The debt asset allocation here for aggressive hybrid fund, it can be in the range of 20 to 35%. And in aggressive hybrid fund, there is a possibility to earn higher returns at a reduced risk. So why do I say reduced risk? Because here we have 20 to 35% of allocation in debt securities, which reduces the risk. The next subcategory of hybrid funds is the dynamic asset allocation fund. So this category is also called balanced advantage fund. So this type of hybrid fund, it is suitable for investors who want to automate the asset allocation. So as the name of this fund suggests, the fund managers in the dynamic asset allocation fund, they dynamically allocate the money between the equity and debt markets based on the preset model which analyzes the stock market conditions. So whenever the stock market, it favors the equity valuations, the fund, it invest more in equities and less in debt. And when the equity valuations, they are expensive, when the stock market is at an all time high, then this fund, it reduces the exposure to equity and increases the exposure to debt. Next, we talk about the multi asset allocation fund. So this is a type of hybrid fund that should invest a minimum of 10% in at least three asset classes. So what are these asset classes? So these asset classes can be equity, they can be debt, they can be gold, they can be real estate. Let us now talk about the features of the multi asset allocation fund. So in these type of fund, there is lesser risk than most other hybrid funds because the investments are spread across multiple asset classes. They are not just invested in equity and debt, but also asset classes like gold and real estate. The next feature is lower allocation to stocks, which means that the returns can fall behind in rising markets. Okay. Finally, the last feature is that these multi-asset allocation funds, they are suitable for investors with an investment tenure of minimum 3 years. Talking about the next category of hybrid fund, which is the arbitrage hybrid fund. So these hybrid funds, they generate returns by simultaneously buying and selling securities in different markets to take advantage of varying prices. So arbitrage hybrid funds, they have to invest minimum 65% in equity and equity related instruments. Now let us talk about the features of arbitrage funds. So there is no stock market risk because the buying and selling price of the stock is already known to the fund manager who is buying and selling stocks at the prices he already knows, right? So these arbitrage hybrid funds, they are suitable for investors who have investment tenure of 1 to 3 years. Also, arbitrage hybrid fund, they have equity taxation, which means that these funds, they are more tax efficient when compared with fixed deposits. Finally, coming to the last category of hybrid funds, we have equity savings funds. So these hybrid funds, they invest an equal amount in stocks, in FD like instruments, that is debt instruments. They also invest in risk free hedging instruments. So these equity savings funds, they are usually able to provide better returns than bank fixed deposits. Let us now talk about the features of equity savings funds. So these funds, they provide you with up to 30% exposure in stocks, which means that you can see some occasional fluctuations in the investment value depending on whether the stock market goes high or low. Equity saving fund, these are suitable for investors with investment tenure between 2 and 3 years. Also, equity savings fund, they have equity taxation, which means that the returns are more tax efficient when you compare them with fixed deposits. Hello friends. So in chapter 3 we will discuss about the working of mutual funds. In lesson 1 of chapter 3 we will discuss the different ways to invest in a mutual fund. So, the different ways to invest in a mutual fund are lump sum, SIP, STP, and SWP. So, first, let us discuss what are SIPs. So, SIP stands for Systematic Investment Plan. SIPs, it allows you to invest money in a mutual fund scheme in a periodic fashion. And the period can be daily, it can be weekly, it can be monthly, it can be quarterly, or it can be half yearly. Now, if you are an investor with a regular amount of money, such as if you are a salaried person, then SIPs can be a very suitable investment option for you. The second way to invest money in a mutual fund is via lump sum. So, lump sum investments are a one time bulk investment into a mutual fund scheme. And lump sum investments, they are beneficial for investors who have a relatively high investment amount, also who have a higher appetite for risk. The third way to invest in a mutual fund is STP, which stands for Systematic Transfer Plan. So in STP, an investor, he transfers a set amount of money from one mutual fund to another on a regular basis. Example, an STP might move rupees 10,000 rupees every single month from SBI liquid fund to SBI blue chip fund. Now SBI liquid fund, as we know, it is a debt fund. It invests in debt instruments, and SBI blue chip fund, it is an equity fund. It invests in stocks of different companies. So STP is usually, it is used to move money from a liquid or debt fund to an equity fund. And what are the benefits of doing it? So the benefit is that it averages out an investor's purchase price in the equity fund, and it lowers the investor's risk. Now we come to the fourth way of investing in a mutual fund, which is SWP, or systematic withdrawal plan. So a lot of investors, they want regular cash flow from their assets, and usually these people, they invest in bank FDs and postal deposits with the post office. But what has happened recently is that the interest rates on FDs and bank and post office deposits, they are falling consistently, which have caused these investors to be concerned about their future income requirements. Hence, for such investors, SWP is a plan which allows them to withdraw predetermined sums at regular intervals of time, such as they can withdraw the money monthly, they can withdraw it quarterly, or they can withdraw it yearly from the mutual fund scheme in which they have invested. And SWP plans, they are not suitable for all types of investors. They are usually more appropriate for people who have a regular income requirement, such as senior citizens. Now, in lesson 2, we are going to discuss about how we can calculate mutual fund returns. So, there are four methods by which we can calculate the returns of mutual funds. Let us now discuss the first method, which is absolute returns. So, to calculate absolute returns, you just need the initial net asset value and the present day net asset value. So, as we have already discussed, net asset value is nothing but the price of one unit of the mutual fund. So, just like stocks have a stock price, a mutual fund has a NAV. So, what is the formula for absolute return? It is present NAV minus initial NAV divided by initial NAV into 100. So, for example, if the initial NAV was 20 and the current NAV is 35, the absolute returns will be 75%. And in this case, the time period does not matter. So, whether you were invested for 7 months or 7 years, the absolute returns are going to be the same. The next method for calculating returns is the simple annualized returns. So, this is used for checking the annual returns. Okay. And what is the formula for simple annualized returns? It is 1 plus the absolute rate of return raised to the power 365 divided by the number of days and minus 1. So, in our previous example, the absolute returns were 75% and the time period was 7 months. So, just input the values in this equation. So, 1 plus 75% raised to the power 365 upon 210, which is 7 months minus 1, and the answer comes out to be 164%. So this is the simple annualized return. The next method for computing the mutual fund return is compounded annual growth rate, which is also called CAGR or CAGR. So this is used when the investment period is more than 12 months. And although the investment might give different returns in different time periods, the CAGR or the CAGR, it always tells you the average annual growth rate. And what is the formula for CAGR? So the formula is the present day NAV divided by the initial NAV raised to the power 1 upon the number of years minus 1 into 100. And if the holding period is in months, the formula changes to present NAV divided by the initial NAV raised to the power 12 upon the number of months minus 1 into 100. So this is CAGR, which is used for calculating returns if the investment period is greater than 12 months. And finally, we come to XIRR, which is the extended internal rate of return, which is used for calculating the SIP returns. Calculating the SIP returns can be a bit difficult because each investment is for different durations. So methods like CAGR, absolute return, and annualized returns may not be a good fit. Hence, we need to use extended rate of return for calculating the SIP returns. Also, I have provided you with the link to a calculator where you can go and calculate your SIP or lump sum investment returns. So the link is https:/grow.in/calculators. So Grow website is a website where you can create an account and start investing in mutual funds, and you can also purchase stocks directly on the Grow platform. In lesson 3 of chapter number 3, we will talk about the different mutual fund ratios. So, mutual fund ratios are helpful for investors for comparing different mutual funds and selecting the best fund to invest in. An investor can refer to a mutual fund scheme's fact sheet for finding the values of these different ratios. The first ratio is alpha. This ratio denotes how a fund has performed compared to its benchmark index. The baseline for alpha is 0. So, if a mutual fund scheme's alpha is greater than 0, then it indicates that the scheme is performing better than its underlying benchmark index. The second mutual fund ratio is beta. So, this ratio is used to assess how a fund responds to the market fluctuations. For beta, the baseline is 1. Hence, if beta of a mutual fund scheme is greater than 1, then it means that a mutual fund is more volatile than its benchmark index. And if beta is less than 1, then it means that the mutual fund scheme is less volatile than its benchmark index. The third mutual fund ratio is the Sharpe ratio. So this ratio helps us to understand about a fund's potential to generate risk adjusted returns. Greater a mutual fund's Sharpe ratio, better is the fund's risk adjusted performance. So a Sharpe ratio between 1 and 2 is considered to be good. A Sharpe ratio between 2 and 3 is considered to be very good, and a Sharpe ratio higher than 3 is considered to be excellent. The fourth ratio is standard deviation or SD. So standard deviation, it depicts how a fund's current returns have deviated from its average annual returns in the past. A high standard deviation means that there is high volatility in the fund's return. For example, if a mutual fund has standard deviation of 4 and its expected returns are 12%, then it means that the fund returns tend to deviate by 4% on the higher side and 4% on the lower side. This means that the fund can generate 16% returns also, and it can generate 8% returns also. Now coming to the fifth ratio, which is Sortino ratio. So the Sortino ratio, it helps an investor to determine a fund's performance with respect to its downward deviation, especially during adverse economic conditions. So a higher ratio, it tells an investor that the fund has a high potential to earn higher returns without taking any unnecessary risk. A Sortino ratio between 1 and 2 is considered to be ideal. Also, there are cases where Sortino ratio may go up to 3, which is considered to be excellent. The next ratio is R squared. So investors can use the R squared ratio to identify how identical is a mutual fund with respect to its benchmark index. The R squared ratio is measured on a scale of 1 to 100. So if a mutual fund's R square value is 40%, it means that the mutual fund has little correlation with its benchmark. If a mutual fund has R squared value between 40% and 70%, it denotes average correlation with its benchmark. Whereas if the R squared value is greater than 70%, then it means that the mutual fund has a high correlation with its benchmark. The next ratio is the Trenor ratio. So the Trenor ratio, it measures the excess returns that all the securities or financial assets in a scheme earn for every unit of risk which is taken by the overall portfolio. So a higher Trenor ratio is considered to be good for making mutual fund investments. Our next ratio is the information ratio. So this mutual fund ratio tells us how consistently a fund has generated good risk adjusted returns. And an information ratio between 0.4 and 0.6 is considered to be good, and an information ratio between 0.61 and 1 is considered to be excellent. Now we will talk about our last ratio, which is the expense ratio. So expense ratio is a yearly fee that is charged for all the expenses that are incurred by the asset management company, including the fund manager's salary, the administrative cost, the operating cost, and the marketing costs, etc. A higher expense ratio corresponds to lower returns, and hence, as an investor, you would want to choose a mutual fund which charges a lower expense ratio. From an investor's viewpoint, a good expense ratio is between 0.5% and 0.75% for an actively managed mutual fund. Also, an expense ratio which is greater than 1.5 is considered to be very high. Hello friends. So in chapter 4 we are going to discuss about active versus passive mutual funds. In lesson 1 we are going to talk about what is a stock market index, and also we are going to discuss the different types of stock market indices. So let us first talk about what is a stock market index. So stock market indices are performance indicators that indicate the performance of a certain market segment or the market as a whole. So a stock market index is constructed by choosing equities from similar companies or those stocks that match a predetermined set of criteria. And these stocks are already listed on the stock market exchange and are traded by traders. Stock market indices, they can be built using a range of variables such as the industry, segment, or market capitalization. Also, stock market indices, they track the price movement and performance of the stocks that make up the index. Now, this would mean that the success of any particular stock market index will depend on the performance of the constituent stocks of that particular index. Next, we will talk about the different types of stock market indices. So, the first one are sectoral index. So, both the BSE and NSE stock exchanges, they have certain strong indicators that gauge the companies in a given sector. For an example, the BSE healthcare and the NSE pharma indices, they are known to be very good indicators of the pharmaceutical sector. The second type of index is the benchmark index. So here we have two benchmark indices. The first one is the Nifty 50 index, which consists of the top 50 equities, and the second one is the BSE Sensex index, which comprises of the top 30 best performing stocks. So the Nifty 50 is the index of the NSE stock exchange, and the Sensex index is the index of the BSE stock exchange. Now these group of equities, they are called benchmark index because they employ the best standards to regulate the companies. Also, the Nifty 50 and the Sensex, they are considered to be the most reliable source of information about how the stock markets work. The next type of stock market index is a market cap index. Now, as it is clear from the name, these index are dependent on the market capitalization of companies. So, what is market capitalization? Market capitalization is the stock exchange market value of any publicly listed company. For example, indices such as the S&P BSE Small Cap and Nifty Small Cap 50, these are indices that consist of companies with a lower market capitalization. This means that they consist of small cap companies. There are also several other kind of indices such as the S&P, BSE 500, the NSE 100 and the BSE 100. So these indices are slightly larger because they consist of a larger number of stocks. For example, the BSE 500 consists of 500 stocks, the NSE 100 has 100 stocks, and due to the larger number of stocks, the risk in these indices is lower. So investors who have a low risk appetite, they can consider investing in funds that track these indices. In lesson 2, we are going to discuss the breakup of NSE indices by sector. So the first index by sector is the Nifty Auto Index, and as it is clear from the name, this index is designed to reflect the behavior and the performance of the Indian automobile sector. The second index is the Nifty Bank Index. So this index provides a benchmark to capture the capital market performance of the Indian banks. The third index is the Nifty Financial Services Index. So this index, it reflects the behavior and performance of the Indian financial market, which includes banks, financial institutions, insurance companies, housing finance, and other financial service companies. The next index is the Nifty FMCG Index, which is designed to reflect the performance of the Indian FMCG, that is fast moving consumer good companies. Next, the index is the Nifty Healthcare Index. So this particular index is designed to reflect the performance of the Indian healthcare companies. Next, we have the Nifty IT index, which captures the performance of the information technology segment of the market in India. Next, we have the Nifty Media Index, which is designed to reflect the performance of the media and entertainment sector, which includes the printing and publishing companies. Next, we have the Nifty Metal Index, which is designed to reflect the performance of the metal sector in India, which includes mining also. Next, we have the Nifty Pharma Index, which is designed to reflect the behavior and the performance of the pharmaceutical sector in India. Next is the Nifty Realty Index, which reflects the performance of real estate companies that are engaged in construction of residential and commercial properties. Next, we have the Nifty Consumer Durables Index, which is designed to reflect the performance of shares that belong to the consumer durables industry. Next is the Nifty Oil and Gas Index, which is designed to reflect the performance of shares that belong to the oil, gas, and petroleum industry. Apart from the indices that we discussed, there are several other indices such as the Nifty Financial Services 25 by 50 Index, the Nifty Financial Services X Bank Index. Next, we have the Nifty Private Bank Index, the Nifty PSU Bank Index, the Nifty Mid Small Financial Services Index, the Nifty Mid Small Healthcare Index, and finally, the Nifty Mid Small IT and Telecom Index. In lesson 3, we are going to talk about the key differences between active and passive mutual funds. So, we are going to compare active and passive funds on the basis of some parameters. So, first parameter is management style. So, active funds they involve fund managers who undertake active and detailed research and look for various investment opportunities in the stock market before investing. In passive funds, the fund managers they buy and hold securities which are relevant to a benchmark index. For example, if the passive fund it is tracking the Nifty 50 index, so the passive fund managers they will buy the stocks which are relevant to the Nifty 50. The second parameter is the performance objective. So in active funds, the performance objective is to beat the benchmark index. In passive funds, just following or tracking the performance of the benchmark index is the main performance objective. Now we talk about the next parameter, which is returns. So active funds can provide investors with higher returns over the short term, but passive returns historically have provided higher average returns over the long term. Now the next parameter is cost or expense ratio. So active funds they have higher expense ratios than passive funds. This is because active funds they have to hire fund managers who undertake the active and detailed research. Passive funds usually they have lower expense ratios because they only have to track the index and hence the expenses involved are much lesser. The next parameter is risk. So active funds they try to beat the benchmark index in the case of a volatile market. So the chances of returns are also a bit higher and the risk taken is also higher. Now, if we talk about passive funds, then they are obviously less risky compared to the active funds because they are just tracking the index. Now, the next parameter is transparency. So, active funds they are less transparent because the active fund managers they do not disclose their investment approach because of competition. Passive funds they are more transparent because here an index fund is getting tracked against a benchmark index and we already know what approach is being followed. Now in this slide we will talk about the performance of active funds against their benchmark index. So in the first row as you can see it talks about the percentage of active large cap funds underperforming the Nifty 100. So in the year 2022, as you can see, 67% of active large cap funds they underperformed the Nifty 100. This means only 33% of funds were able to give better returns as compared to the Nifty 100. In the second row, we are talking about the percentage of active mid-cap funds that underperform the Nifty Mid-Cap 150. So in the year 2022, 55% of the active mid-cap funds they underperformed the benchmark. This means only 45% gave better returns than its benchmark index. Now we talk about in the third row, the percentage of active small cap funds that underperform the Nifty Small Cap 250. So in the year 2022, 13% of small cap funds they underperformed the benchmark. This means 87% funds were able to beat the benchmark, which is a good number. But if we talk about the year 2021, then 48% of small cap funds they underperformed the Nifty Small Cap 250 benchmark. So now the question comes that whether an investor should invest in an active mutual fund or a passive mutual fund. So if the investor has a high risk tolerance, then he can consider investing in an active mutual fund. But if he has a low risk tolerance, then he should consider passive funds. Also, a good approach here would be to invest in a mix of active and passive funds to diversify the portfolio and also reduce the risk. In lesson 4, we will discuss how an investor can choose the best index fund. So, for choosing the best index fund, an investor should consider the following factors. He should select an index fund that most closely tracks the performance of the index. This means that the index fund that he is investing in should have a low tracking error. Also, he should select an index fund that has a low expense ratio. The expense ratio does not need to be the lowest among the category peers, but it should be towards the lower end of the spectrum. Now, we will talk about what exactly is tracking error. So, the tracking error it indicates the variability in the performance of an index fund. So, if an index fund has a very high tracking error, then it can defeat the entire purpose of index investing. For example, suppose an index fund, suppose an index gave 13% returns in a calendar year. So, suppose the index was Nifty 50 and Nifty 50 gave 13% returns in a year, and an index fund that was tracking the Nifty 50 it gave only 10% returns. So this type of investing will not be of any use because the returns are almost 3% less. Hence, it is very important to choose an index fund which has a very low tracking error and is able to replicate the returns of the index. So to conclude this lesson, an investor should always select an index fund that has a low tracking error and also has a low expense ratio. In lesson 5, we will talk about ETF versus index fund. So, first, let us understand what exactly is an ETF. So, ETF stands for Exchange Traded Fund, and it is a basket of securities that you can buy or sell through a brokerage firm on a stock exchange. So, for buying or selling ETF, you need to have a demat account with the brokerage firm. And there are just so many brokerage firms today in India, such as Zerodha, Grow, Angel One, etc. So, you can open a demat account with any one of them and start trading in ETFs. Now, we will talk about the key differences between ETFs and index funds. So, the first parameter on which we will compare the two is expense ratio. So if I talk about Nifty 50 ETFs, then they have average expense ratios of just 0.07%, which is much lesser as compared to the expense ratio of Nifty 50 index fund, which is 0.22%. And this data is taken as of June 2023. The second parameter where we will compare ETFs and index fund is the tracking error. So ETFs they have a much lower tracking error as compared to the index funds. This means that ETFs they do a better job of tracking the index as compared to index funds. The next parameter where we will compare the two is returns. So in this case also the ETFs they have an upper edge over index funds. So if we talk about the 5-year average returns of Nifty 50 ETFs, they were 13.53% as compared to 13.23% for Nifty 50 index funds. Again, this data is taken as of June 2023. Now we talk about the fourth parameter, which is liquidity. So liquidity is not a cause of concern with index funds because the fund house, they have to honor the buy and sell orders. But with ETFs, before investing, an investor has to be careful about the liquidity, and they should only invest in ETFs which have high liquidity. There are lots of ETFs in the market where the liquidity is low, and an investor should refrain from investing in such ETFs. The fifth parameter is price NAV gap. So since the ETFs, they trade in the market in real time, there is often a demand and supply gap which controls their prices. And this demand and supply gap, it often results in the prices of ETFs deviating from the NAVs, whereas no such issue is there in index fund. Now let us talk about which out of index fund and ETF is better for an investor. So if an investor is comfortable operating a demat and a trading account, and they can assess the ETFs for their price gap, price NAV gap and liquidity, then an investor is better off investing in ETFs, because ETFs can save you money as they have a lower expense ratio, and they also track the index better, so you will get better returns than index funds over a long period of time. However, investors who are not comfortable operating demat and trading account and they want to keep it simple, then for them index funds are the best way to invest. Also, another advantage of index fund is that they provide you the SIP facility, and they are more suitable for long term investors because they can continue their SIP for a long period of time. On the other hand, if someone is interested in doing intraday trading, then ETFs are a better choice for them because you can buy and sell during the market hours. Also, in ETFs, you can do manual SIPs, and today there are certain brokers that have started providing the SIP option in ETFs also. So, an investor can pick whichever out of ETF or index fund suits his requirements better. Now, an important point to note here is that whether an investor chooses ETF or index fund, they should invest regularly and also keep a long term horizon, because both these options, ETF and index funds, they can help you reach your goals and create wealth for yourself and your family over a long period of time.
In Chapter 5, we are going to discuss about direct and regular mutual funds. In Lesson 1 of Chapter 5, we will talk about the key differences between direct and regular mutual funds.
So every mutual fund, it comes in two versions. The first one is direct and the second one is regular. So in the direct plan, an investor has to invest directly with the asset management company, and there is no distributor involved to facilitate the transaction. In the regular plan, an investor invests through an intermediary such as a broker, a distributor or a banker, who is paid a distribution fees by the asset management company. The direct plan obviously has a lower expense ratio because there is no distribution fees involved, whereas the regular plan has a higher expense ratio, and this expense ratio is usually about 0.5% to 2% higher than the direct plan, and this is done to account for the commission paid to the distributor. Thus, if an investor chooses to invest through the direct plan, he will be able to get higher returns because he is saving in expenses. He is paying a lower expense ratio, but he will not be able to avail the distribution and related services of the intermediary, which he would be getting if he invests with a regular plan. So let us now talk about the key benefits of direct mutual funds. So the first benefit is the returns. So direct mutual funds, they provide higher returns than regular funds because A person buys the direct funds directly from the AMC or selected online sites, and this leads to significantly higher savings in the long term. The second one is the lack of an intermediary. So, as you know, that an intermediary is absent in the case of a direct fund because you are buying the mutual fund directly from the asset management company. Whereas in a regular fund, a broker is present who mediates between the investor and the AMC. Next benefit is expense ratio. So as we know, the expense ratio is lower in case of direct funds and higher in case of the regular funds. So coming to the fourth benefit, it is NAV, that is net asset value. So just like stocks have a stock price, a mutual fund has a NAV. So direct funds have a higher NAV because they have a lower expense ratio. Now we talk about the fifth benefit, that is simplicity. So direct funds are simple in nature because the process of investing is simpler as there is no intermediary or broker involved in between. So now we talk about the conclusion. So in my opinion, direct funds are definitely preferable for an investor if they can do their own due diligence and research and monitor the fund performance on a continuous basis. In lesson 2, we are going to talk about a real world example to see the difference in returns between regular and direct mutual funds. So, for this, we will take the example of Nippon India Small Cap Fund. So, in the last 10 years, the direct plan of this scheme has given 31.46% annualized returns, whereas the regular plan has given 30.21% returns. And this data is taken from the Association of Mutual Funds in India, AMFI website. And this data has been tracked till August 31, 2023. So as you can see, the difference between the annualized returns of the direct plans and the regular plans for this particular scheme is 1.25%. Now let us assume that an investor is investing via SIP in this particular mutual fund scheme for 20 years. Now, the first case is when this investor invests through the direct plan. So, at 31.46% annualized returns from the direct plan, the investor would be able to create a corpus of rupees 19.5 crores in 20 years. And the monthly SIP is rupees 10,000 as we discussed earlier. Now, case 2, if the investor invests via the regular plan, so he will be able to create a corpus of around rupees 15.9 crores at 30.21% annualized returns, which is 3.6 crore rupees less than the direct plan. So, as you can see, that just by switching from the regular plan to the direct plan, the investor can earn rupees 3.6 crores more. So, if you can do your own due diligence and research and pick your own mutual funds, then it is always advisable to invest via the direct plan because you will get much higher returns over a long period of time. In chapter 6, we will talk about how debt mutual funds work. In lesson 1 of chapter 6, we will talk about the risk versus returns in case of debt funds. So, investors, before they make any investment, they should understand that risk and return they are directly proportional. So, your return expectations they should be proportional or they should be commensurate with the risk profile of your investment. Also, in case of debt funds, investors they should know and they should be aware of the link between investment tenure and risk capacity, since both the interest rate risk and credit risk in case of debt funds it increases as the investment tenure increases. So, for example, if you are investing in a debt fund for a longer period of time, then both the interest rate risk and credit risk it will be higher. So hence you should select funds according to your risk appetite. Always check the debt fund fact sheet before investing in a debt fund. So that will give you an idea about the type of credit quality that the debt fund is investing in. So funds which invest in lower rated instruments, they carry a higher credit risk and can give higher returns. But because they have a higher credit risk, you have to be very careful before investing in it. Credit risk is permanent, and if the issuer defaults, then your loss is also permanent because there are very little chances of recovery in that case. And in the current economic environment, the credit risk is a lot more dangerous, and hence, before making any kind of investment, an investor should understand the credit risk of the instrument and make an informed decision. In lesson 2 of chapter number 6, we will talk about how CRISIL rates debt instruments. So, as you must be knowing, credit ratings are assigned to various debt instruments by a number of credit rating agencies that we have in India, such as CRISIL, ICRA, Fitch, and others. Now, here, if we are talking about debt instruments that are long term instruments and have a maturity of more than 1 year, then the following credit ratings are assigned by CRISIL. So, what are those ratings? The first rating is CRISIL AAA, which has the highest safety and it is considered to be the rating with the lowest credit risk. Then the next is CRISIL AA, which has a high safety. Then comes CRISIL A, which has adequate safety. After that, we have CRISIL Triple B with moderate safety. Next, we have CRISIL Double B with moderate risk. Next, we have CRISIL B with high risk. Next is CRISIL C with very high risk. And finally, we have CRISIL D, which is where the probability of default is very high or the instrument has already defaulted. So these were the various ratings in case of long-term instruments with maturity greater than 1 year. Next, we will talk about short-term instruments, how short-term instruments are rated by CRISIL. So short-term instruments, these are instruments with a maturity of less than 1 year, and we have the following ratings which are given by CRISIL. So CRISIL A1, which denotes the highest margin of safety and it has the lowest possible credit risk. Next, we have CRISIL A2, which has high safety. Next is CRISIL A3 with moderate safety. Then we have CRISIL A4 with minimal safety. And finally, we have CRISIL D, where the probability of default is very high. So finally, the conclusion is that before an investor invests in debt mutual funds, he should always look at the mutual fund fact sheet, wherein he will get the details about all the debt instruments that the mutual fund is investing in, and he can also see the ratings of those instruments, and he will be able to take an informed decision. Thus, he will be able to invest only in those debt mutual funds which are investing in low credit risk instruments. So, in lesson 3, we are going to talk about the Franklin Templeton debt fund crisis. So, Franklin Templeton is an asset management company, just like we have HDFC Asset Management Company and SBI Mutual Fund. So, in a similar way, we have Franklin Templeton. So, as COVID-19 it spread worldwide, we saw how the equity markets they reacted. They fell by almost 40% in 40 days, and also the debt markets they froze. So why did the debt markets freeze? Because so many people were rushing to withdraw their investments, and the asset management companies they were not able to encash their securities to provide money for those withdrawals. So a similar thing happened with Franklin Templeton, wherein it was faced with a lot of redemptions and illiquid portfolios, and it could not encash the securities in its debt portfolio. So on April 23, 2020, the asset management company Franklin Templeton it announced that it was winding up the six debt schemes. And which were these six debt schemes? So the first scheme was Franklin India Ultra Short Bond Fund. The second was Franklin India Low Duration Fund. The third was Franklin India Short Term Income Plan. The fourth was Franklin India Income Opportunities Fund. The fifth one was Franklin India Credit Risk Fund, and the sixth one was Franklin India Dynamic Accrual Fund. So the combined AUM of these six debt schemes was rupees 25,215 crores, and this data is as of April 2020. Now, what happened was eventually these schemes were able to liquidate all the holdings and disburse the proceeds to the unit holders. But this liquidation and disbursement took a time period of about 2 to 3 years, and during this time, the investors' money was stuck with the AMC. SEBI did probe the incident and it found serious lapses and violations by the AMC. SEBI observed that Franklin Templeton did not adequately monitor and manage critical risks such as credit risk, liquidity risk, and concentration risk because it was single mindedly pursuing the aim of reaping high returns. So, the lesson here for the investors is that they should not take risk for earning 1 to 2% extra return without understanding which instrument the debt fund is investing in. So, if a debt fund that you are investing in is offering higher returns than other debt funds in its category, then you should always study the debt fund's fact sheet to analyze the credit rating of the instruments that it is investing in. In this way, you will always invest in funds that are investing in high credit quality instruments and your money will be safe. In chapter 7, we will talk about how to invest in mutual funds. So, in lesson 1 of chapter 7, we will discuss how an investor can invest in mutual funds online. So, the method 1 is that he can create an account on an official website of the asset management company. So, every asset management company it has an official website where an investor can find multiple mutual funds in each category such as mid cap, small cap, large cap to invest. So an investor just has to follow the instructions provided on the official site and he has to fill in the required information, whatever is asked by the AMC, and submit it. So here the KYC process can be completed online, and for the KYC only the Aadhaar number and PAN number are needed. So once you have provided all the information, it is verified at the back end and it takes some time which varies from AMC to AMC, and then you can start investing once the verification is successful. Now talking about the method 2 of investing, which is through a mobile app. So a lot of asset management companies they also have a mobile app to make investing quick and hassle free for the investors. Now, apart from AMCs, a lot of third-party mutual fund aggregators they have also come up and they have started providing a mobile app for the investors to invest in mutual funds. So this app it enables the investors to invest in different schemes, view their account statements, buy and sell units of mutual funds, and check other relevant details. Also, the best thing about third party apps is that you can invest in various funds offered by different fund houses and not just be restricted to funds from a certain mutual fund house. Also, a lot of AMCs they continue to provide this feature of investing offline. So you can invest offline also if you do not prefer the online mode. In lesson 2 of chapter 7, we are going to talk about the best apps to invest in mutual funds. So, here I have a list of 8 applications. All these apps they are third party aggregators. So, let us look at these apps. So, the first one is ET Money, the second one is Grow, the third one is Zerodha Coin by Zerodha, the fourth one is My CAMS, the fifth one is Paytm Money by Paytm Company. The sixth one is Kuvera. The seventh one is 5 Paisa. And the eighth one is Piggy Mutual Funds app. The best part about all these mobile applications is that they help you to invest through the direct route, which helps you save lakhs of rupees on commissions. I personally use ET Money and Zerodha Coin for my mutual fund investments. In chapter 8, we will talk about how to choose the best mutual funds. In lesson 1 of chapter 8, we will discuss the important points that an investor should keep in mind before selecting mutual funds. So the first point is investment horizon. So, as we know that equity funds are best suited for meeting an investor's goal if they have a long investment horizon. Whereas, if an investor has a short to medium term investment horizon, then he should be choosing debt funds. The second important point to keep in mind is investment objective. So, if an investor's objective is capital appreciation, growing his capital, then he should be choosing equity funds. Whereas, if an investor wants a regular income, he should consider debt funds. The third parameter is risk profile. So equity funds, they are suitable for investors with a moderately high to high risk appetite, whereas if an investor has a low or a moderate risk appetite, then he should choose debt funds. Also, within the equity funds category, the large cap funds, they are suitable for investors who have a moderately high risk appetite, whereas the mid cap and small cap funds, they are very volatile and hence are suitable for investors with a high risk appetite. The next important point that investors should keep in mind is the fund manager and the fund house track record. So, an investor, before investing, they should always check the long term track record, that is, the 3-year, 5-year, and 10-year record of the scheme, if available. Also, they should look at the fund manager and the fund house before investing. They should thoroughly research about the fund manager and also check the credentials of the fund house. Next important point is expense ratio. So, as we know that actively managed funds, they have the capacity to generate high alphas, and that may compensate for the higher expense ratios they charge. But in my opinion, one should ideally not invest in actively managed funds that have an expense ratio greater than 1%. On the other hand, we have index funds and ETFs which just track the index. So, in this case, the expense ratio is very important, and one should always consider investing in index funds and ETFs which have a very low expense ratio. Now, we talk about our next point, which is taxation. So, in case of equity funds, your short term capital gains, that is, if you hold your investment for less than 12 months, then it is considered a short term capital gain and you are taxed at 15%. And your long term capital gains for the investments you hold more than 12 months, they are tax exempt for up to rupees 1 lakh capital gain, and after that you are taxed at 10%. Now we will talk about taxation in case of non-equity funds. So for non-equity funds, your short-term capital gains for the investments that you hold for less than 36 months, they are taxed at as per your income tax rate. And your long-term capital gains that you hold, the investments that you hold for more than 36 months, they are taxed at 20%. So I hope the taxation for equity funds and non-equity funds is clear. In lesson 2 of chapter number 8, we will discuss how an investor can select the best mutual fund. So, once an investor has decided which category of fund they want to invest in, such as they have decided that they want to invest in a large cap fund or a mid cap fund or a small cap fund or a flexi cap fund, then they should keep in mind a few points before they start investing. So, the first point that they should keep in mind is the returns. They should always compare the last 3-year, 5-year, and 10-year returns of the various schemes. Obviously, the higher returns, the better. But here, one point to keep in mind is that past returns do not always guarantee future returns. The next point that we need to keep in mind is the fund manager and the fund house credentials. This becomes more important when a person is investing for the long term. The next important point or parameter that an investor should keep in mind is the expense ratio. Obviously, the lower the expense ratio, the better. But if a mutual fund scheme it has given better returns as compared to its peers, then even a higher expense ratio can be considered. But in my opinion, one should refrain from investing in schemes which have expense ratio of greater than 1%. Next important point to consider before investing is the alpha. So alpha, it represents a mutual fund manager's performance in comparison to the benchmark index. So alpha greater than 0, it demonstrates that the fund manager has been able to outperform the benchmark index. So a mutual fund's alpha should always be greater than 0, and that will mean that the mutual fund has outperformed the benchmark index. Next we come onto our next parameter, which is beta. So beta, it demonstrates a fund's response to the market volatility. Beta greater than 1, it means that the mutual fund, it demonstrates a more significant shift in its price as compared to the benchmark index. So ideally, beta should be around 1 or less. And as we discussed previously, alpha should be greater than 0. The last point to keep in mind before investing is diversification. So the investor should not invest everything in a single scheme. Instead, they should try to diversify their investments and invest in 2 to 3 top performing mutual funds in a category. In chapter 9, we are going to discuss how to build a mutual fund portfolio. In lesson 1 of chapter 9, we are going to talk about the 6 steps which an investor can take to build a mutual fund portfolio. So, the first step is to identify your goals. The first step towards building a mutual fund portfolio is to identify the goals that you are building the portfolio for. So, these goals can be anything like building your dream house, planning for your child's education, or investing for your retirement. The best thing about goal identification is that it helps you decide the time horizon of investment. So this time horizon, it helps you determine the level of risk you can take. For example, if you are investing for a time period of 20 years, then you can obviously take a lot more risk as compared to if you were investing for just 1 or 2 years. In step 2, we will select the investment options. So once we have identified our goals and the time horizon for the investment, we will proceed to selecting the right investment opportunities or options. For example, if an investor has a short to medium term time horizon of say 1 to 3 years, then he can invest in short to medium term debt funds and stay away from equity. Generally, it is advisable that for investing in equity, one should have a time horizon of 5 to 7 years. And if the time horizon is lesser than that, then debt funds or hybrid funds are the ideal choice. Now, if an investor is confused about which equity fund he should invest in, he should start with index funds because unlike active funds, index funds, they do not try to beat the indices or the benchmark. They just try to replicate the performance of the underlying index. Also, historical data has shown that across categories like small cap, mid cap, and large cap, active funds they have found it very hard to outperform their benchmark indices. Hence, by investing in active funds, an investor would not be compromising on returns. Now, step 3 in building a mutual fund portfolio is to diversify your investments. So, once an investor has identified his goals and the asset class that he wants to invest in, then the next obvious step is to diversify his investments. For example, let's say that you want to save and invest for your child's higher education, and for this, you have a time period of 10 to 12 years. So, in this case, a major proportion of your investment should be in equity, but you can also try and include some gold and debt components in your portfolio because what they will do is hedge your portfolio. That means they will reduce the risk in your portfolio without reducing your total returns significantly. Also, you can decide your asset allocation percentage depending on the level of risk you can take. For example, if you can take more risk, you should allocate 60% towards equity, 20% towards debt, and 20% towards gold. So, in this way, you will get more returns also, and the gold and debt components in your portfolio will help to reduce the volatility and risk. Another important point here is that an investor should also diversify his investment within the same asset class. For example, if you are investing in equity, then you can diversify by investing in large cap, mid cap, and small cap funds. So, having mid cap and small cap funds, they can significantly boost your returns in the long term. Now we come to step 4, which is start investing through SIPs. So SIPs, as we know, are systematic investment plan, and this is the most important step. So here, execution is more important than planning, and a lot of investors, even after doing the three steps, they postpone their decision to invest. So one important reason why investors they postpone the decision to invest is because they lack experience in investing in the stock market, and they fear losing money in the stock market. So the solution here is to start small, start SIPs with small amount, and once you have gained more experience, you can gradually increase your investment amount. For most investors, SIP or systematic investment plan, these are the best way to invest because they instill investment discipline, and they help to average your investment cost over time, which helps you to reduce the impact of volatility on your returns. Hence, to conclude step 4, I would say that as a beginner, you should always start small SIPs and slowly and gradually increase them as you gain more confidence. Now, we move on to step 5, which is to review and rebalance the portfolio. So, the frequency of reviewing and rebalancing is up to the investor, but in my opinion, it should be done at least annually. So, here, what you will do is you will revisit the steps 2 and 3 where you have identified the different asset classes and decided the asset allocation. So over time, it is possible that the stock markets have given good returns, or the debt proportion of your investments have given good returns, and your asset allocation in that case will be out of balance. So rebalancing your portfolio is important in this case to bring it back to your desired asset allocation. Also, during step 5 of reviewing and rebalancing, you should review the performance of your active equity funds in your portfolio. And if you find that they are underperforming their benchmarks for more than 2 years, then you should consider switching to better active equity funds. Now we move on to step 6 in our mutual fund portfolio building, which is disciplined investing. So as we know that investing in mutual fund, it requires discipline and a very well thought out approach. You have to stick to your plan and not get affected by the market volatility. So, the best way to follow a disciplined approach is to never miss your systematic investment plan or SIP. You should keep making your SIP payments without fail because it gives you the benefit of cost averaging, and you can accumulate a huge corpus in the long run. Another key feature here is to have a long term horizon because stock markets they can be unpredictable in the short term, but historical data shows that the returns are generally high over a long period of time. Also, you should regularly review your mutual fund portfolio and make changes to it. If any mutual fund scheme it is not performing well for more than 2 years, you should consider exiting it and switching to better schemes. In lesson 2 of chapter 9, we will talk about when an investor can consider exiting their mutual fund investment. So, if an investor has achieved their financial goal earlier than planned, then they can exit from the mutual fund scheme, and they can shift their corpus to a liquid fund or even a bank FD to preserve the amount that they have accumulated through the equity scheme. Also, if an equity scheme has been underperforming for the last 3 years or more as compared to its benchmark and peers, then the investor can consider exiting the scheme and transferring their investment to a similar fund that has given better returns in the past. The next point or case where an investor can consider exiting their mutual fund investment is when the fund undergoes a fundamental change. So, when can a fund undergo a fundamental change? This can be on account of a change in the fund manager, or a change in the fundamental attributes of the fund, or a change due to the regulatory norms. So, in this case, an investor should definitely track the fund performance over the next 6 to 12 months after the changes. And if the fund underperforms drastically, then they need to review the entire portfolio, and they may also want to shift their investments to a better fund. The next point where an investor should consider exiting a mutual fund investment is when a change in asset allocation occurs, right? So, a change in asset allocation may occur when there is a rise or fall in the stock market. For example, if you have asset allocation of 60% in equities and 40% in debt, and the equity markets they rally and your equity allocation goes to 65%, then you will need to reduce your equity allocation to 60% by selling some of your equity investments. Now, the next case where an investor can consider exiting the mutual fund investment is in the case of a rare event where the AMC, whose schemes that you have invested in, is sold to another fund house, and the scheme gets merged with a similar scheme of the new fund house. So, in this case, you need to evaluate your new scheme's performance, objectives, and holdings to see if they have changed or not. And if you see a drastic change, then you can consider switching to a new scheme. Finally, you can consider exiting your mutual fund investment in case of an emergency, when your emergency funds are insufficient to deal with the situation. Also, if you are unable to pay your SIP installments for whatsoever reasons, you can also pause your monthly SIP for a while. So, these were the 6 cases when you can consider exiting your mutual fund investments. In lesson 3 of chapter 9, we will discuss how compounding works in the case of mutual funds. So, assuming that an investor has a monthly SIP amount of rupees 10,000, and we are expecting a rate of return of 12% per annum. So, if we would have invested in any Nifty 50 index fund, the historical return rate for the last 10 years has been 13%. So, we can safely assume a return rate of 12% for our calculation. So now we will see what the estimated returns or profits have been for various time horizons. So considering if the investment tenure was 3 years, so in this case the invested amount would have been 3,60,000, and the profits would have been 75,000, approximately 75,000. If the investment tenure was 5 years, the invested amount would have been 6 lakh, and the profits would have been approximately 2 lakh 24,000. If the investment tenure was 10 years, then the investment amount would have been 12 lakh, and the profits would have been approximately 11 lakh 23,000. For investment tenure of 15 years, the invested amount was 18 lakh and profits were approximately 32 lakhs. For 20 years investment tenure, investment amount was 24 lakh, and the estimated returns or profits were 76 lakh approximately. For investment tenure of 25 years, the invested amount is 30 lakh, and the estimated returns or profits are rupees 1 crore, 59 lakh, and 76,000 approximately. For investment tenure of 30 years, the invested amount is 36 lakh, and the profits are 3 crores, 16 lakh, and 99,000 approximately. So, as you can see from this table, the benefits of compounding are a lot higher when the investment tenure is more. Now, if we compare the investment tenures of 10 years and 20 years, you can see that in 10 years the invested amount is 12 lakh, and in 20 years invested amount is 24 lakh. That means that the invested amount has become 2x from 10 years to 20 years. But if we compare the profits in case of 10 years were almost 11 lakh, whereas for 20 years they were 76 lakh. So the profits have almost gone 7x, and the investment amount has just 2x. So you can see how the compounding has worked here. Similarly, you can compare 10 years and 30 years investment tenures. So in 10 years you invested 12 lakh, and in 30 years you invested 36 lakhs. So the investment amount has increased by 3x. But if you compare the profits for 10 years were almost 11 lakhs, whereas for 30 years they were 3 crore 16 lakhs. So the profits have increased by almost 30 times. So this is the power of compounding. Hence, it is always advisable to keep your SIP active for the long term in order to gain the maximum benefits of compounding. In chapter 10, we will talk about small case versus mutual funds. In lesson 1 of chapter 10, we will discuss what is a small case. So, the concept of small case was brought about in the year 2015 by a fintech startup named as Smallcase. So, Smallcase, it represents a bundle of stocks that follow a particular theme, idea, or sector. And Smallcase allows investors to buy a portfolio of stocks directly within their demat account, and the investors, they do not need to invest via the mutual fund route. So many brokers and wealth managers, they have adopted the idea of small case, and they have now started offering small cases as portfolios on the small case website. So small case today, they have a large number of ready-made portfolios from licensed SEBI professionals. For example, a chemical small case, it is a portfolio of prominent companies in the chemical products industry. Similarly, a pharma small case can be a portfolio of prominent pharma companies operating in India. So a small case, it can be focused on popular market themes like GST or electric mobility or smart city, etc. They can also be based on financial parameters like debt-free companies or different risk profiles of an investor. So there can be a small case for aggressive investors who want higher growth, and there can be another small case for conservative investors who want to preserve their capital. Similarly, small cases can also be based on investment philosophies like those of Graham and Warren Buffett. In lesson 2 of chapter number 10, we will compare small cases and mutual funds based on different parameters. So the first parameter is investment amount. Small cases, they need a higher capital because investors need to buy at least one share of each company in order to create a portfolio. On the other hand, mutual funds, they allow investors to achieve diversification and invest in different shares with much lesser amount, since there is no requirement to buy at least one share. In many mutual funds, the minimum amount for lump sum investments and SIPs can be as low as 100 rupees. The second parameter where we will compare small case and mutual funds is exit load. So in case of small cases, they do not have any additional exit load. That means an investor can withdraw their investments and they will not be penalized or charged any fees. Now we will talk about exit load in case of mutual funds. So in certain mutual fund schemes, there is a exit load of 1% if the units are sold within 1 year from the date of purchase, and the exit load, it varies from scheme to scheme. So it might be the case that a number of schemes, they do not have any exit load associated with them. The next parameter where we will compare small case and mutual funds is control over investment portfolio. So in case of small case, the shares, they are directly credited to the investor's demat account, and the investor gets the choice to buy or sell any share of the small case. Also, manual rebalancing is required in case of a small case, whenever you get the notification via app or email from the small case manager. Now, in case of mutual funds, an investor has the freedom to choose the type of mutual fund based on their sector or theme or asset class, but one cannot select which shares he wants to invest in. Also, in the case of mutual funds, no manual rebalancing is required. Thus, we can say that small case offers better control over the investment portfolio, but manual rebalancing is also required, which takes time and efforts on the part of the investor. The next parameter where we will compare small case and mutual funds is the holding pattern. So in case of small case, investor requires a demat account where the shares will be credited, and also if the shares provide any dividends, they will get reflected in the investor's bank account. In the case of mutual funds, the investors are given the mutual fund units and they are not given the shares directly. Also, in the case of mutual funds, there is no need for the investor to open a demat account. The next parameter for comparing small cases and mutual funds is the expense ratio. So every small case has a different expense ratio. Some small cases they are free of cost and the investor can invest in them without any fees, whereas certain small cases they require a subscription amount to be paid. Now, in the case of mutual funds, the expense ratio usually varies and it is between 0.05% to 2%, depending on the scheme. Usually, expense ratio is much lower in the case of debt and index funds, and it is higher in the case of actively managed equity funds. Next parameter on which we will compare small cases and mutual funds is the risk involved. So, small cases they usually come with a higher risk as compared to mutual funds because of lower diversification. Small cases usually invest in lesser number of stocks as compared to mutual funds, and thus they are more volatile and hence more risk is involved. In case of mutual funds, the diversification is usually higher than small cases. The fund managers of mutual funds they adopt various risk mitigation strategies and they also ensure regular review and monitoring and rebalancing. In lesson 3, we will discuss which out of small case and mutual fund is a better investment choice. So mutual funds they usually have lock-in periods, there is lower transparency and also investors have lesser control over the portfolio. On the other hand, small cases they do not have any lock-in periods. There is usually more transparency and also investors have greater control over the portfolio. But another point to consider here is that investing in small cases it requires knowledge of the stock market. Also, investors in small cases they need to pick their own small case based on their goals and also rebalance them at regular intervals. Also, the investment amount in case of small cases is usually a lot higher as compared to mutual funds. In case of mutual funds, investors they do not need to have any knowledge of the market. The mutual fund managers they will take care of the portfolio and also decide when to enter and exit the stock market. So all the investors have to do in case of mutual fund is to choose a mutual fund that is in alignment with their goals and profiles. So, finally, concluding this chapter, we can say that investors who have a higher investment amount, a higher risk tolerance, and also adequate knowledge of the stock market to manage their own portfolio, these people can consider investing in small cases. And if you do not fall in this category, then you are better off investing in mutual funds. In chapter 11, we will discuss about the top mutual fund mistakes that an investor should avoid. So, the first mistake that many investors make while investing in mutual funds is that they chase performance. So, it is really tempting to see a mutual fund give high double digit returns and invest in it, hoping that the mutual fund will continue to give good returns. But in a lot of cases, it does not happen. This is because the top performing mutual funds change every year. So, how can an investor mitigate this issue? They can mitigate this issue by diversifying their investment and investing in 3 to 4 top performing mutual funds in a particular category. The second mistake that a lot of mutual fund investors make is that they invest in sectoral or thematic funds. So many investors are attracted to sectoral and thematic funds because these funds give good short term returns. But sectoral and thematic funds are more riskier as compared to diversified equity funds. One of the major challenges of investing in sectoral and thematic funds is guessing which theme or sector is going to work, because every year the top sectors or themes they keep changing. The next mistake a lot of mutual fund investors make is that they do not review their portfolio on a regular basis. Now, a slight deterioration or a slight drawdown in your fund's performance over the short term is not a cause of concern. But if your mutual fund scheme continues to underperform the benchmark, or it continues to underperform its peers for more than 2 years, then you should consider exiting the mutual fund scheme and investing in better schemes. The fourth mistake that mutual fund investors make is that they invest heavily in mid cap and small cap mutual funds. So, just like sectoral and thematic mutual funds, mid cap and small cap funds they attract a lot of investors. In bull runs, the mid cap and small cap funds they tend to give very high returns, and many investors find this very difficult to ignore. But mid cap and small cap funds they are not meant for all types of investors. Only if an investor is willing to take higher risk for better returns, they should consider investing in mid cap and small cap funds. The fifth mistake that a lot of mutual fund investors make is that they do not have a financial plan. So many mutual fund investors start investing right away without even knowing what they want to achieve with their investments. So even if an investor is doing his SIPs diligently and he is having a long term focus, he will not be knowing how much to save for which goal if he does not have a financial plan beforehand in place. The next mistake that many investors make is that they invest in the regular plans of mutual funds. So as we have already discussed that regular plans of mutual funds they entail distributor commission, so the mutual fund house has to incur higher expenses, and these higher expenses ultimately they translate into a higher cost that you have to pay in the form of higher expense ratios for regular plans, and this ultimately leads to lower returns. On the other hand, direct plans of mutual funds do not have commissions involved, and hence you can earn much higher returns as compared to regular plans over a longer period of time. The seventh mistake that mutual fund investors make is that they invest in the IDCW option of mutual fund schemes. So every mutual fund scheme it has two investment options. One is IDCW and the second one is growth. IDCW stands for income distribution cum capital withdrawal. So this option is provided by AMCs in case you need payout from your funds. So, in my opinion, the growth option in mutual funds is better because it helps in better compounding of your capital. Also, the payouts from IDCW schemes they are irregular and they may be insufficient for your needs. The eighth mistake that many mutual fund investors make is that they invest their short term money in equity. So, an investor should never invest in equity for the short term, and one should always have minimum 5-year horizon before investing in equity funds. Also, for riskier equity categories like mid cap and small cap, it is better to keep a 7-year horizon. So, keeping these time horizons will ensure that you will always get the best returns from equity funds. So, friends, I hope that you went through the course and were able to learn something new. So, if you have liked the course, then please hit the like button, share the video with your friends and family, and also subscribe to my YouTube channel. Also, hit the bell icon so that you get notifications about my new videos. Thank you.